Right, well, good morning, ladies and gentlemen, and welcome to CAS. My name's Alex Moss, for those of you who don't know me. I'm Director of the Real Estate Research Centre, and they'll now follow a 60-second commercial on behalf of the CAS Real Estate Research Centre, but I promise it's only 60 seconds. One point of housekeeping: in the unlikely event of a fire, the fire escape is directly by reception. So you should make way there, and that's the housekeeping over. What do we do here at CAS, in particular for the Real Estate Research Centre? Our main aim is this point about building the bridge between theory and practice. So we aim to do a number of things. We do a few reports. We're currently doing 2 reports for the IPF, one on the size and structure of the UK market and one on ESG factors in terms of benchmarking performance. We host events. We're delighted to host this on behalf of AREF, but we also produce our own events. Last night we had an event on sustainability, and we've got several more lined up for the 3rd and 4th quarter this year. We do, for those of you who love academic papers, and I know that applies to an awful lot of you, we do several academic papers for publication in those journals. And we also do executive education. So today we're here, this is the home of the executive education part of CAS. And funding is via sponsorship from our industry partners. The one thing I would say to you, if you're interested in these events and what we're doing, please do sign up to the mailing list, which is here on our website, where you can see details of all the events we have forthcoming, and you're being kept in touch with everything that we're doing. So, as I say, we're delighted to host this, which I think is the 3rd event we've done for AREF and the 2nd in this series. And I'd now like to hand over to Patrick, who's going to tell you the format for today.
Thank you, Alex. Welcome, everyone. As Alex said, this is the 2nd in our 3-part series on fund lifecycle events and fund structuring. We held an event back in February on the high-level overview of some legal and regulatory aspects of fund structuring. We're going to have a 3rd event later in the year on fund launch and deployment, so looking at some of the more commercial aspects. But today we're going to be exploring a bit in more detail around the tax aspects of fund structuring, and then I think James is also going to talk about some Channel Islands offshore structuring aspects. Firstly, I'd like to thank Alex and the rest of the team at CAS Business School for hosting us today, and also Kerry Olsen for sponsoring the event. So before we move on to the presentations, I would just like to see how much familiarity there is in the room with some of the stuff we're going to be covering today. So you may or may not be familiar with Slido. For those of you who aren't, if you could get out your smartphone browsers and visit slido.com and enter the reference hashtag X127. And then I'm hoping you should be presented with the following poll. And if you could select the different topics that you actually have some level of familiarity with. Okay, so looking like the CGT and ATAD. We've got 2 responses. Okay, so what it looks like, hopefully we're at the right place today. We're going to cover all these in a bit more detail. So without further ado, I'm going to hand over to our first guest speaker, Leonie Webster from Deloitte.
Thank you. I'm actually going to try and stand over here, if that's okay, with you guys on this side. I think you can all see me. So I'm going to start the presentation today by taking you back in time. To 2006. Now, I can imagine looking at the demographic in the room here that actually probably a lot of you weren't in the working environment in 2006. I had just come back from a secondment in New Zealand with Deloitte, and that was the year that I really started getting into structuring real estate funds. So before I explain why we're going to go back to 2006, let's just start by a little poll of, can you think back to what you were doing then in 2006? Anybody want to admit to being in the working environment? I'm suspecting not many of you. Just one person here. A couple of people. Okay. A few people, maybe a few. Yeah. I get you guys. What about university? Anyone at university? Okay. A few more people. Secondary school? Gosh, yes, you're making me feel old. Anyone at primary school? I don't want to, no, okay. So you might wonder why on earth I am taking you back to 2006 if most of you actually weren't in the working environment then, and it's a good question. And actually the reason is simplicity, because when we talk about fund structuring today, when we talk about the tax outcomes from fund structuring, it is really very complicated. There's an increasing amount of complexity, an increasing amount of uncertainty. There are new rules coming in all the time. Actually, back in 2006, things were much more stable, much simpler. So I thought, actually, just to start this discussion today and to start to get some of the principles, some of the building blocks out there, we would talk about 2006, where things were simpler and easier to explain. So, back in 2006, you might have seen something like this, and it's fair to say actually a lot of our fund structures were pretty similar. They would probably have had a few more tiers, so I have simplified this quite a lot. You'd have quite a lot more jurisdictions. So this is a European fund structure, obviously, investing in real estate. We'd have started at the top, quite often with a English limited partnership, which was really flexible, good vehicle for for the commercial and the legal things that you needed to build into the fund. We'd have then had a Luxembourg holding platform, typically, and then a mix of local and non-local propcos actually holding your real estate. So quite often German and UK assets would be held through non-local propcos, often Luxembourg for Germany and Jersey for the UK. We've then got a sort of random Dutch company in there holding our Spanish propco. So you will notice actually that with this there's not a lot of conformity, there's a lot of different jurisdictions here. So it was operationally more complex. But as I said, the tax was simpler. So if we go through how the tax works in this fund structure in 2006. So at the bottom, obviously we've got property in all of these jurisdictions. The local jurisdictions will tax that at the prevailing rate. They'll tax your rental income, but they will give you a deduction for your expenses. So the biggest expense you've got is obviously in a real estate context, interest. So interest on your external and internal financing. You'll see here with the red dotted lines, we're putting in internal debt. And back in 2006, getting a deduction for that was in most places was relatively simple. Some places would have what we call thin capitalisation rules, which would tell you how much debt and equity you needed to put in the structure. But many jurisdictions would just simply say, if that's equivalent to arm's length, you can take a deduction. Pretty straightforward, especially back in 2006 when I think we all know pre-credit crunch the banks were lending quite a lot of money to everybody. So actually the level of interest you could deduct was quite high, which means your tax base, your taxable profits were lower. Then we tried to get money out. Most of these local jurisdictions would have withholding tax. So they would, when you pay out interest and dividends, they would apply a withholding tax to that. And that varies in rate and can be anywhere up to the mid-20%. But because we're paying to Luxembourg and we're a resident in Luxembourg, we've got a certificate, we get that down to zero under the treaties and directives. So no tax there. Luxembourg itself doesn't tax that income because it has exemptions for dividends and capital gains, and it recognises a margin on its interest financing. So, not too much tax so far. We then get up to the top, our fund vehicle. Our English limited partnership is not an entity for tax purposes. It's transparent, it's not seen, therefore it's not taxable. Sometimes that might be replaced with something called an FCP or perhaps one of the other Luxembourg fund vehicles, which would either again be transparent or exempt from tax under fund law. So a lot of simplicity, certainty. We could get Luxembourg rulings to confirm the treatment in the structure. We would use instruments at the top to take the cash back to investors. Not really got an awful lot of tax in this structure. And also, the important point here, which is the point at the top, is regardless of who your investors were, the tax outcomes were the same. So you put the same structure in place and you got the same tax outcomes. Now, I suppose the other thing to say actually is just thinking about when we then exit the fund, if we sell the properties, we'll have tax in the local jurisdiction. But quite often if we sell shares, actually tax gets allocated to Luxembourg rather than the local jurisdictions back in 2006. For example, if we'd sold the shares in the French propco back in 2006, France would have tried to tax that, but under the treaty it had agreed with Luxembourg at that point, Luxembourg would have been able to tax it rather than France. So again, on exit, quite often we don't have too much tax. Then things started to change. And where we've ended up today is as a result of a number of different factors, which we're going to talk through. So first of all, we had the credit crunch. Obviously, I know most of you, even if you weren't in the working environment, would be very familiar with that. We also had a real change in the way that business was done, the technological revolution. You know, back in 2006, we didn't even have a smartphone, let alone Slido. So things have really, really changed in the environment. And at the same time, we had this big focus in the media on tax. So there were lots of stories about particularly big technology companies like Amazon and Google seemingly making these enormous profits and yet paying no tax. So the global community had to react. It had to do something, and it did. It initiated the BEPS project, which I know some of you, obviously, from the comments you made are familiar with. This is base erosion and profit shifting. So this was looking at how do we tax in the new world where business is done in a different way? And how do we make sure that people are paying the right amount of tax, that they're not eroding their profits by taking too much deductions for interest, for example? BEPS, they came up with 15 actions, and that was then has been then put into EU law through the Anti-Tax Avoidance Directive. It's the ATAD, which was in my list. And that needs to be implemented, or needed to be implemented, depending on which one it is. There's ATAD 1 and ATAD 2, by the local jurisdictions. So some of it has already been implemented, and some of it will be implemented over the coming years. So what has that done? What has that introduced that will affect our real estate structures? Let's just go back and think about our building blocks. So first of all, I was saying the first key thing is deductions for interest. Well, what those rules, those BEPS recommendations and the ATAD rules do is they say you have a limitation on the amount of interest you can deduct. So the rules will be applied differently in different countries, but very broadly, you'll be restricted to 30% of your EBITDA. That means if you've got 100 of rental income, very broadly, you can take a deduction for 30 of your interest. And that's not very high for a real estate business where actually interest will be a big cost. Some of the countries have de minimis limits, but again, those are applied in different ways. So Germany, for example, in our German structure, each company in Germany has a de minimis of 3 million that they can deduct. For the UK, that de minimis is 2 million and it applies per UK group. So there's some differences between the treatment and also we don't yet know exactly how all of the jurisdictions will be implementing these rules, so some level of uncertainty as well. But it's fair to say there's more complexity there and also more tax to pay in most of these jurisdictions and in most structures. We've also got the anti-hybrid rules, which were on my list as well, and I know not many people are familiar with, and I don't blame you. And I'm certainly not going to spend too much time talking about them because, to be honest, we could be here all day and I would just bore you to tears. So I think the important things for you to know about the anti-hybrid rules are that they're very widely drafted, they can strike in all sorts of different ways. But basically, if you have an instrument, debt instrument, or an entity which is seen differently by two different people, then that could be a hybrid issue. And that means that you might have another restriction on your interest deductibility. So in my situation here, if we had, let's say, an investor at the top who saw that ELP as a corporate, but the structure sees it as a partnership, that's a hybrid issue. If we have a US investor who has made a check-the-box selection for US purposes so they can see that Master Luxco as transparent, but everyone else sees it as a corporate, that's a hybrid issue. If you have a profit participating loan which somebody sees as debt and somebody sees as equity, that's a hybrid issue. So there's many ways this can catch you. And I think the important thing to realise is that actually, again, there's complexity. Again, there is also probably increases in tax. And again, there's uncertainty because we don't yet know exactly how all the jurisdictions will be implementing these rules. Some of the jurisdictions in the EU are yet to announce how they're bringing them in. In terms of our next building blocks, repatriation of income, you remember I said that when we were taking the cash out, we didn't have to worry about withholding tax because we were paying to Luxembourg. Actually, this was the focus of the OECD too, and the EU as well. And what they're now saying is, well, it's not just good enough just to have one man and his dog in Luxembourg and be resident there. That's not going to fly. Actually, what is your purpose for putting in that Luxembourg company? Why have you done it? Have you just done it to benefit from the treaty or directive, in which case you're not going to get access to it? Again, uncertainty, because what does purpose mean? I mean, do I need to have 1,000 people there? Do I need to have an operating platform? Is it okay if my fund is based there? I don't know. We don't yet know exactly how jurisdictions will implement that. Uncertainty, more tax potentially. Taxation of gains. I said before, quite often taxing rights were allocated to Luxembourg and there was no taxation of gains. That's changed as well, partly by jurisdictions just renegotiating treaties. So France and Luxembourg renegotiated their treaty. France now has the taxing rights. The UK and Luxembourg are also renegotiating that treaty as well. That is a trend that's been ongoing and will continue to be. So it's fair to assume that on exit, you're going to pay tax. Real estate transfer tax. Back in 2006, people were doing sort of planning, all sorts of planning ideas. Now, those have been all prevented through anti-avoidance legislation, which has been brought in. So again, another change, another trend. And finally, we've had changes in the Luxembourg environment as well. Now, people don't get rulings anymore. So that level of certainty that ruling gave you is really gone or no more. You have to take certainty around the advice that you've been given, but clearly in this changing environment, you don't necessarily know that tax environment is going to still be there at the end of your fund life. And I guess the other thing to say as well is that this is on this list. So there has also been an increase in choice as well. So whereas previously I said, pretty much all the structures look very similar, now we've got a whole host of different options to choose from. So back in 2006, US REITs were very popular, but REITs in Europe weren't really something that people necessarily used. The UK introduced a REIT regime in 2007, extended it out in 2012, and now we commonly see these vehicles used. So UK REITs, French APCIs, Spanish SACIMIs, Italian REITs, all of them have got their own conditions. And again, I don't have time to go through each of those conditions in detail. But the one thing about them is what they do is they exempt the vehicle from tax on the property income and gains. And instead that tax applies when you distribute money to investors. So that means that actually it's not about the taxation of the fund at all. It's about the investors. It's about their profile and their tax position. I mentioned before that if investors see the vehicles differently to the structure, that can create anti-hybrid problems. Suddenly we're seeing that the way that investors look at things, the way that investors view things, and their tax profile is becoming more important, which it never was in the past. And that can create its own difficulties. So what does this all mean for today? Well, this is an example of how a European fund might be structured today. But as I say, there are many more choices. So you might see REIT-type structures put in there, depending on your investor base. But you might see something like this. So here, the one difference from before is you've got uniformity around the jurisdiction. We've just got Luxembourg here. People are saying, well, look, if I need to build a platform in Luxembourg, if I want to put my people into Luxembourg and build something there, then I want to have as much as possible there. I want to put my fund there. I want to have my holding platform there. And if I can, I want to have my property companies there as well. The Luxembourg SCSP was obviously put forward as a rival to the ELP. That has taken off in popularity for European fund structuring. And in terms of the tax here, well, at the bottom of the structure, we've still got tax locally, regardless of whether we've got a Luxembourg company or a local propco. The local country where the asset is located will still tax that income. But as I said, we've got much reduced interest deductions because of the 30% EBITDA rules, because of the anti-hybrid rules. when we bring cash out through the structure, we're going to have to start thinking about, well, can we get relief under directives and treaties? And if we can't, let's say we had a Spanish PropCo in here and Spain said, no, I don't think you've got enough purpose, enough substance, or perhaps that you're not the beneficial owner of the income, because actually the income's coming up on a debt instrument and going straight out to somebody else. So I don't think you really are the proper beneficiary of that treaty or directive. What happens then? Well, does the local jurisdiction then look up to the investors and say, well, actually, I think you guys are the beneficial owners, so I'm going to apply a blended rate based on your profile and your treaty rates? Again, we're back to investors. And these are trends that we're not seeing happening at the moment, but they're things that could come further down the line as countries start to establish their position around BEPS, treaty access, directive access. So I guess the important points to remember from this slide are, tax is increasing in uncertainty. We're going to end up paying more tax. We've got less deductibility of interest. We've got tax on our gains. We've got potential risk of tax as we bring money up through the structure. But we've also got this uncertainty. We don't necessarily know how all the rules are going to play out and come in. We've definitely got more complexity. I mean, the anti-hybrid rules alone in the UK go on for pages and pages. To actually be familiar with them and make sure that you really understand them is quite a task. And finally, we've got this trend that the taxation and the profile of investors is becoming much more important. So it's less about the tax and the structure and more about the investors. I've got the UK structure here off to one side, and that's probably a good way of illustrating that these points too, is that the UK taxation of UK property has changed enormously, or is changing actually. Some of it hasn't yet come in from 2006. Back in 2006, we had our traditional holding structures. We had our offshore corporates, Luxembourg or quite commonly Jersey, to hold our UK real estate. Perhaps we'd have used a Jersey property unit trust. All of these entities would have been exempt from capital gains tax. From an income perspective, the JPIT's transparent, so the income tax is paid by the unit holder, but again, deductions were available for arm's length debt. So actually the tax base, was relatively low. What's changing? Well, obviously we've already had the introduction of NRCGT, which people are familiar with, and hopefully you've come along to our previous presentations on that. And next year, from April 2020, all of our non-resident landlords will be within the corporation tax regime. And that means, guess what? We have 30% EBITDA restrictions, we have anti-hybrid rules, we have the complexity of the corporation tax legislation. So again, complexity is there. More tax, absolutely, tax will increase for most of these structures. But again, more choice. So as I said earlier, we've got the REIT regime now, which people are looking at as an option for their UK structures. We've also got the two new regimes that were introduced as a result of the NRCGT changes, the transparency and the exemption regime. I'm not going to go into those in detail, but hopefully people are familiar with that change. Now, all of these structures, again, have that common feature of saying there's an exemption at the fund level and the tax arises at the investor level. So again, this is about investor profile, investor tax, which is good because it means they can access their own exemptions, their own treaty rates, etc., etc. But it also means that they may have different preferences. Suddenly their views are becoming more important. Even in a standard corporate structure, where we have company holding company, if we sell the shares in the property owning company, UK property owning company, then there is an exemption which applies, substantial shareholdings exemption, which depends on, again, the nature of your investors. So we've got greater choice. We're also thinking, should we have an onshore and offshore structure? Should we go into the exemption regime, the transparency regime? Should we use a UK REIT? Actually, what's our investor base? What would they prefer? A lot more choice, a lot more complexity. And as I said, investors may have different preferences. So two very ostensibly similar investors might prefer completely different things because of what's better for them and because of their profile. So I guess just to summarise where we've got to. From 2006, we really have had a revolution in tax of fund structuring. And we're now in a position where we've got absolutely less interest deductibility, more focus on cash repatriation and tax on cash repatriation as it comes through the structure, more tax on exit, and less certainty about how long the tax laws are going to last, and indeed what they're going to be, with all of the, the implementation of ATAB, which will be happening over the next few years. We've also got this growing trend for distinctions between investors, because it's more about their profile. They're the ones that are actually going to be more interested in the structure. So you're going to have more focus from investors on, well, what is the structure? What does that mean for me? And actually, if the structure is getting a benefit because of my status, I want that benefit to come to me and not be shared with other investors. Or if somebody else is causing a problem because they see the vehicle differently to the way that I do, and there's an anti-hybrid issue, well, I want that cost to go to them and not to me. Things become more complex. There's more discussion around the commercial arrangements as well. Also means that funds will need to know a lot more about their investors and what their status is. So if you look at the way the UK rules are going, actually if you elect into the exemption regime, you will have to do reporting on your investors. So you will need to have that information available to you on an annual basis. I think the other trend that we've seen is because of the focus in the media on tax, that both fund managers and investors are really much more focused on risk and reputation. How is this going to impact my reputation if somebody looks at this and says this is tax aggressive? Investors will be asking, well, what are your policies around tax? Actually, what decisions will you make? How will you take advice? How will you make sure that the position is certain and protected? So, again, uncertainty. How do you do that in an uncertain environment? How does a fund manager answer those questions when they don't even know what's coming in? I think the key here is just making sure that you're keeping informed with the changes that are happening, modelling appropriately and modelling sensitivities, and also keeping flexibility, because it's likely that things will have to change over the life of the fund. We're not in that situation where we say, back in 2006, yeah, this is the right structure, this is the one you go with, and this is going to stay for the life of the fund. Actually, things are changing all the time, and we need to be flexible to react to that, and make sure that actually we can, move and do the right thing when we need to. So if I can leave you with those themes of increase in tax, uncertainty, complexity, more choice, and also this growing trend for things to be more about investors than about the fund itself and about the structure itself, then that really tells the story, I think, of the move from 2006 to now, and also what potentially might be coming down the line in the future. So I think we might have another question on Slido. This is based on what you've heard, what concerns you most? Uncertainty in the tax environment, increasing complexity, differing preferences and level of choice. Okay, uncertainty seems to be pretty popular. Yeah, and I think, these top two are pretty interesting, and they are what people are really concerned about. How do you structure a fund today if you don't know exactly what the tax laws are going to be in a couple of years' time? That's pretty hard. How do you manage that, and how do you answer those questions, and how do you keep informed of what's happening, especially when you've got a pan-European fund with several jurisdictions doing completely different things? That's pretty tough. Differing preferences, we're really seeing this in practice now with some of the UK structures, actually, that investors are having these discussions and saying, well, actually, I want a transparent structure, and somebody else is saying, no, I want an exempt structure. How do you resolve that in a JV context or indeed in a fund context? complexity obviously is, it is an issue. There's an increase in there's a cost factor to complexity as well, and also a kind of worry about something being missed. A level of choice. I mean, obviously, only people have chosen 5% of people have chosen that. It is an issue because the more choice you have, the longer it takes, I guess, to reach a decision on what is most appropriate, particularly when you're taking into account the differing preferences as well between investors, and you're actually getting pressure perhaps to do one thing or the other.
Leonie, we've got a question on
Okay.
slide. And by the way, we will have a Q&A at the end of the session, but if you do have any questions as we're going, you can submit those on Slido as we go. But it's essentially looking at, with investors, the increased importance of the profile. Do you think that's influencing investors' behaviour in their investment strategies?
Not yet, but it may well do. So if you, obviously, you want to try to offer a structure to investors which is going to give them what they want and the returns that they want. Now, clearly, if they're comparing two products in the future, and actually one gives them a better return because it means they can access their own exemptions, for example, then they're more likely to be able to, to wish to choose that one. Whereas in the past, really investors would have got the same outcome. So actually the difference was therefore all about the commercials and the return, et cetera, and tax didn't really play a factor because the tax was all dealt with by the fund and the investors just didn't see it at all. So I think there will potentially be a trend towards that, particularly given the level of choice and the fact that funds can make different choices around the structure that they put in place. What we might see, actually, is potentially a sort of funds that look a little bit more like US funds, where you have a number of different feeders for different types of investors. So you sort of try and cater for all of their requirements in one fund, rather than trying to have a one-size-fits-all, which is pretty much what we've got at the moment, actually, in terms of bringing them all into the same fund.
Okay.
So I will hand over to James to do the next session. Thank you.
Thanks, Leonie. It's been a while since I've sat through a tax presentation, understood most of it, or found it digestible, so thank you very much. I thought that was excellent. James Mulholland. I'm a funds and corporate partner sitting in Jersey. Carry also one of the largest firms in the Channel Islands. I'm talking, I guess I have a Channel Islands hat on, but actually what I've got to talk about is really generally about funds, because I think one of the things we've definitely heard from here, if to get the right tax outcome, and we've seen some of the pretty pictures that Leonie has shown up there, the lawyers then need to then make that structure work and turn that from a piece of paper into life in a way. So actually to get the right tax outcome, we need to get the structure right and we need to get the corporate and the funds analysis right as well. So in the sort of 10-15 minutes I have, I want to just sort of discuss 4 points with you, or just relay 4 points to you. Firstly, the basic question, what is a fund? And there are many definitions, but just knowing to spot a fund, what are the vehicles commonly used for those funds? And again, I'm talking just generically, so Lux, UK, and the Channel Islands. Do we need to be regulated? And because does that define your tax outcome as well? And then fourthly, once we've got, what does that look like when we're putting it to life? So who are the main players and the participants, the actors in the structure charts when we bring it to life? So what is a fund? Well, there are millions of definitions of funds, and probably every jurisdiction and every regulator has their own views on funds, but I think you can just sort of distill it down to some basic principles. It is a pooling of money by investors into probably a common vehicle whereby there is a principle of risk spreading underneath by that vehicle. So the key features are the pooling of the investors, so more than one investor, and then secondly, that vehicle then has a principle of risk spreading. That actually may not mean that it's more than one, in the real estate world, may not be more than one asset. You could say if you took this building here, We have we may have a little bit of resi upstairs. We've got office here. On the ground floor we've got retail. So you could argue, and we often do, that that is actually a principle of risk spreading, because that's different types of landlords, that's different types of underpinnings of those income drivers. So that's how we often think about things when trying to spot a fund when it hits us in the face. So it doesn't mean it's a joint venture, but there are occasions where naturally, well, the joint venture partners don't really have much of a say. They just put their money in and then that's it, and then they sit back and wait for the returns to come out. So that's probably more like a fund. So you just need to be cognizant that funds come in different shapes and sizes, and therefore that has an impact on the corporate and the regulatory piece. We tried to sort of put into buckets the three different main types of fund vehicles. So this is answering question number 2. What common vehicles do we use? Firstly, companies, but then within our toolbox, our sort of funds toolbox, be that UK, Lux, or the Channel Islands, we've got private companies, we've got public companies, we have cells, so that we have protected cell companies and incorporated cell companies, so those are different mini companies within inside a larger company. All different shapes and sizes. So it's just to remember that it's not just a plain vanilla company. And each of those cells will have their own board, and that could be a fund, or the overall cell company could be a fund. So there's lots of different optionality. Within that, though, and then we were talking about REITs. So REITs is been very popular from a UK perspective, as you say, Leonie, for the last 10 years, and we've certainly seen a Channel Islands impact on that, because you can have a Jersey or Guernsey company, although UK tax resident, to operate as a UK REIT. And also you can have them as private companies rather than PLCs. So we are seeing a lot of companies being used now still as a fund vehicle. Limited partnerships, especially I guess if you move to the private equity real estate model, LPs are very much we find is a used familiar vehicle of choice. Again, in our toolbox, we've got lots of different types. So we've got the regular plain vanilla limited partnership. There's something called a separate limited partnership, which is a bit like the Scottish limited partnership. Again, it's just slightly different. We have an incorporated limited partnership, which behaves a bit like a company, but still is a limited partnership. So it still has that sort of transparency. So it has a sort of a quasi-hybrid view to it. And then we've got a little bit more sort of funky things like LLCs, which is effectively, that's used a lot in the US, as limited liability companies. Even though they call themselves companies, they're effectively partnerships of sorts. So, and then we also have the limited liability partnership in the UK and the Channel Islands. Not just professional services firms, but also funds are now starting to see the benefits of a limited liability partnership as their vehicle. And then we've also got the tried and tested, good old, slightly boring, but they're great fund if you're a geeky funds lawyer to play with, and that's the unit trust. You have English unit trust, you have Jersey, the JPUT, the Jersey Property Unit Trust. They're fantastic because they are very flexible. And when people think, oh, trust, that's a bit sort of old school, a bit boring and everything else, but actually they're to play with and to get the right outcomes from a corporate and funds perspective, unit trusts are very good because there's just some basic principles that the trustees need to worry about, but otherwise there's a lot to play with. There's no restrictions like company law restrictions, what companies can and can't do. So unit trusts are still very popular. So this is going on to the third question. Do funds have to be regulated? And if so, why? And how do we regulate them? Not to be answered within the next 2 minutes, but it's really to flag that you are, once we've got this structure up and we've told, right, this is how we've got to play with it and this is how we're going to bring it to life, there are some impacts about what that structure might actually look like, and is it a fund? If so, does it need to become regulated? The reason why it needs to be regulated, there are probably some basic questions you'll look at within the context of that transaction. Are your investors demanding that you must actually be regulated because you need a kite mark to say from a regulator to say yes, we've done our due diligence on this manager, we're comfortable that this manager is known to us, is responsible enough to operate a fund and take investors' monies in. That's probably less important if actually all your investors are super sophisticated or pension funds or institutional investors. Far, far more important if you're down the retail end, and then there's a sliding scale in between. So just bear that in mind. So are your investors sophisticated? And also, how many investors are you likely to have? If you've got one or two, then maybe you can get away with a bit of regulation. If you've got, say, 60, 70, 80, 100, then you're well into a regulated form of fund. So the consequences, well, the Jersey regulator will look at the fund, or any regulator will look at the fund itself and also the manager. So that could be, so going back here, the limited partnerships, it could be the general partner, who's the operator of the limited partnership, or the trustee manager, who's the operator of the unit trust. So there's regulation at the manager level and also at the fund level. A big driver that sort of shook up the institutional funds industry in Channel Islands and also in Europe as well, because it had a wide-reaching effect, was the Alternative Investment Fund Managers Directive that came in now about 5 years ago, and we're all still trying to grapple with it and learning to live with it. That's basically said for if you're going to market, if a manager is going to market a fund into Europe, be it outside of Europe or be a manager inside of Europe, and remember Channel Islands are outside of Europe for these purposes, but Luxembourg, UK is still inside Europe for these purposes, then there are base levels of expectation of regulation that the manager and the fund need to adhere to. And those vary. So if you have a non-EU manager, say a Jersey manager, but it manages a UK, an English unit trust, that's a different outcome to, say, a Luxembourg SPCP that we've been talking about before with a Luxembourg manager. All different types. But ultimately, it drives what our answer is to how can we get this regulated and what's the best regulatory box to put this in. So when we get an instruction to ask about, we've got a new deal, we've got a new fund to launch, what's the best box, pigeonhole to put this in? We basically ask, who are your targeted investors and what's their degree of sophistication, and how many are you going to? And often the third question is, are you marketing to Europe, because AIFMD will have a part to play in that. So what that has meant that most jurisdictions, Lux, UK, Jersey and Guernsey certainly, have then just pulled out a long list of different regulatory regimes that they can offer promoters, investment managers, to provide. So listed funds, great for the UK REIT option. Expert investors, eligible investor type structures, that's great for private equity real estate, super sophisticated pension fund type investor products. Jersey private funds, they've been very good for sort of small scale JPUT type transactions that they then try and roll out from what was once a JV to something bigger. They proved to be very popular. And then we're moving down the scale to retail and quasi-retail, which to be honest, is not a Channel Islands play. We still see it in the UK and also in Lux. There's also probably one one further aspect just to highlight is that not all funds need to be regulated. So actually, if you do have super sophisticated investors and you're not marketing to Europe and you've only got a couple, then you can there are certainly unregulated options. So that is all available to you. So just quickly moving to the fourth and final question. Well, what does this all look like and how does this play out? So this is actually quite similar to Leonie's last diagram slide. In a way, you probably don't think so, but I can assure you it is. It's effectively saying there are many parts and many players involved in playing out this scene, but ultimately you have the fund, the unit trust, for instance. You'll have holding vehicles, so we talked about, say, Luxembourg vehicles. You may have a limited partnership that could sit below the fund, or it could even sit above the fund, an English limited partnership we often see. But more importantly, you'll have a trustee and a manager, may actually be the same entities, and they are there to operate the fund. The other service providers, that's actually pretty fundamental because often in these situations, they are sort of an outsourced administrator, or they're a bank who acts as your custodian, or there's a depository involved. And these are some of the service providers that we were talking earlier about, some of the BEPS and Substance. They're showing that actually in this fund, we've got actually bums on seats, people working on these vehicles to show that there is genuine substance and there's income accruing in the right place to be booked in the right place. And then the final slide is just a little bit of a take-home. It's just for you to recognise there's some different what these actors are doing. So trustee holding the assets, got a fiduciary duty to hold the assets to act in the best interests of the unit trust. The manager may be the same entity, may not be, but that's effectively that could be you. You could be sitting in you could be a board that sits in Jersey. It could be someone in Luxembourg, someone in the UK. But they're often making the investment decisions, so portfolio management, risk management type decisions. You may have an investment advisor that could be onshore that's making recommendations to the manager to make the decisions for buy, sell, leverage, debt, key events of the fund. Administrator, this is the other service providers. These are the people providing the administration, NAV, calculations, accounting work that's all going on to give the investors what they're expecting and to support the manager in their role. There's also custodian as well. That may well be a trustee, but just to say that there could be a custodian depository lurking in there as well. So those are the 4 points that I really want to do. Spotting a fund when you see it. Just recognising what type of vehicles you may be asked to play with or use. Thirdly, think about the regulation, because that will have a big tax outcome if you don't get it right. And fourthly, just think about the bigger picture. Who are the other participants in a fund structuring context? Because that's going to, it's going to affect the complexity of your transaction, timing, and everything else. There we go.
Got a question here that touches on your last slide around the different players, and it says, what are the key differences between a trustee and a fund manager?
Good question. Who's going to own up to that? So a trustee's role, purely as a trustee's role, is you're holding the assets for the benefit of the fund, so effectively your investors. Okay, and that's purely their role. They have a fiduciary duty, an obligation to act in the best interest. The fund manager can be used in quite a sort of colloquial and broad-brushed. It can have many different definitions in terms of if you're being quite generic or being quite specific. If you're being generic, it can be. You could be actually meaning the investment advisor on that previous slide. You could be just talking about your team that sits in London that makes those investment decisions, so your investment advisor. or it could actually be the manager that is making the which is often the could be the trustee manager, or it could be a separate vehicle that is making those being delegated to make the investment decisions. So that's portfolio management, so buy, sell, leverage, deleverage, exit strategy, strategic views, keeping within investment policy, and so on. And also risk management, so that very much so. Are we operating within our investment strategy? Have we got our hedging right? Are we exposing our currency risk, and so are we? What counterparty risks do we have, and so on? So a fund manager can have many different definitions, so you have to be quite careful what that means. But roughly, it is the portfolio and risk management role. We've got any easier questions?
Well, slightly off topic, but what role do you see technology playing in terms of the funds industry and a kind of disruptor to the status quo?
Yeah, that's quite interesting, because I'm sure Leonie's colleagues are massively involved in blockchain and how that's going to affect fund management. Blockchain is going to, and digital is going to affect in two ways, from what we see. And one's just part of the digital revolution that everyone's talking about, and one is actually a little bit more interesting for me as a geeky funds lawyer. The first one is about driving efficiencies for the manager and the operators and the administrators, using blockchain to be more efficient, driving down your tier and your cost base. So there is something there that the digital revolution is going to deliver to fund management, and so be it. That's just got to happen in a competitive world. Actually, probably what's a little bit more interesting for me is, and I guess Jersey's had a huge role in that, is that we've been looking at, for instance, regulating, and the regulators worked with us on regulating crypto-based funds, ICO-based funds, and there's no doubt that we're going to see an ICO or tokenization of funds as well. So you don't buy a unit, you don't buy a share or a limited partner, you're going to get some form of token that's going to have a quasi-legal role that sits as a share or a unit, but also is a token from what we're all going to see, what we all know about in ICOs. Maybe it won't happen on this sort of crypto wave that we've just seen, but there's no doubt that that's coming. And so a lot of the jurisdictions are now trying to figure out, scratch their heads about how do we tokenize shares, how do we tokenize units of a unit trust and limited partnership. So I think that's actually the funds challenge that you and I will face, or you being much younger than me, Patrick, you'll be facing much sooner rather than later. Okay. Any questions for Leonie?
Yeah.
Can I sit down?
One for Leonie here, probably, that you talked about potentially there being a move towards more US style, where you try and structure a fund for many different types of investors with different feeders or parallels or whatever. I guess the counter to that is, do you see there potentially being a trend for fund managers launching products just at specific classes of investors?
Potentially. I mean, I suppose it depends on how widely you want to market it. And I think that sort of idea of having, I guess when you look at the US structures, there's more complexity at the top, but the quid pro quo of that is there's less complexity at the bottom quite often, because actually the structuring is done at the top part rather than the bottom. So, it's not necessarily saying that we're suddenly going to have a fund structure that goes on to 16 pages, whereas previously it would have been on one. Actually, I think the balance is just changing between the top side and the bottom side potentially. But equally, there might be situations in which you just can't achieve it. You can't kind of market to everybody. So you have to say, well, this is my main market. This is what I'm going to try to attract. And if other people want to come in, well, that's fine. But we're going to have to sort of structure for them off to one side.
So I have a question follow up that. Sorry, Leonie, we haven't prepped for this, but it's quite interesting because I guess if you look at the private equity world and their fund structuring these days, which is half my other client base, you will have the basic fund say that be in Jersey or Guernsey or even Luxembourg, but then there are many, many different arms and legs growing off it. So it's much more complicated for a typical sort of upper to mid-market fund size. So you have Luxembourg sleeves, you have a Jersey co-invest vehicle and a US, a Delaware feeder and so on. Is that, is the real estate world just 10 years behind that, or do you see it, or is there other drivers?
I think that's right, and a lot of that is because of the US investors. So you've got sort of different US investors wanting to block things and others wanting to have things open. So you've sort of been structuring for a US tax problem, which almost is now becoming, I guess, more of a global tax point around saying, well, investors will be pulled into different categories. So when you see those structures, you'll see your feeder for 892 investors, and you'll see your feeder for just taxables. And so I mean, as I say, we're not seeing this yet. This definitely isn't something that is happening right now. In fact, people structuring funds right now are saying, look, let's actually try and keep it simple for now until we see where things are going to end up, and then potentially introduce that complexity later on. And that really comes down to that point about keeping flexibility in the documents, so that you can restructure, so that you can move people into different feeders if you need to in the future. So it's definitely, I would say, more of a trend for the future.
I think that touches on one of the other questions. You talk about flexibility in the documents. How easy is it with the increasing tax burden and all the additional regimes to actually have effective flexibility to be able to restructure a fund going forward without triggering tax burdens?
And that's true. I mean, one of the sort of things we always say is, if you've got German assets in the fund, you're going to have a problem restructuring because you crystallise real estate transfer tax in a lot of different ways. It flows right up through the structure. So it does depend on that's a typical tax person's answer, but it does depend on what you've got in your fund at the time as to how easy it is. And I think that is one of the conundrums at the moment, is saying, well, when do we make our move? When do we say this is going to be our structure? And actually you can keep flexibility for so long, but you're absolutely right. By the time you've got your kind of fund structure set up, you might look at it and say, okay, so I've got the flexibility, I can restructure, but I'm going to crystallise a huge tax liability somewhere. So suddenly it takes that flexibility away. So I do think keeping monitoring it, looking at what you've got in there. Some people are thinking, well, actually, I'll just make the decision when I do the first investment. Kind of at least try and get some more clarity about where some of these rules are going to end up before I make a decision.
And up top on the investor level, you definitely, especially in the private equity world, you'll definitely see a general partner power within your limited partnership agreement to say that GP has a right to shuffle around the investors into the different pools and the different investment vehicles, because there are implications on the other investors if we don't get this right. And then also the GP will also have a power probably down below or within the terms of the limited partnership to reshape the limited partnership agreement to get the best tax outcome. So that we certainly see that in private equity, and I'm sure that's going to just flow to real estate.
I just wanted to pick up on the point about sort of blockchain technology as well, because I think that's really interesting, and it's certainly in the tax world. This is another real revolution we're seeing, because one of the trends, which I didn't touch on but is important, is that the amount of information tax authorities have now is growing. You've got all your sort of FATCA, CRS, you've got your information sharing, you're going to have mandatory disclosure in the EU. There's an awful lot of information that's going to be out there. And I guess as technology kind of is used to distill and use that information, it will be interesting to see what that means in terms of how people use it. Tax authorities use that in terms of challenging fund structures or seeking to change regimes. So that's certainly another trend that we're likely to see.
Maybe one more for you. One more maybe for Leonie. In the age of uncertainty, how ultimately does the fund manager choose which structure to go for? Do you think that's now primarily driven by who they're going to be targeting?
Yeah, I think that's right. And there was always that, when we thought about fund structures, we were always, one of the questions was always, well, who are your investors? What are you going to do? Who are your investors? But I think that now that's become more important. And that will drive some of that decision making alongside all of the other things around, what kind of vehicle do you want, what regulation do you want, etc. Where are you going to be investing in the UK structures? Yeah. And there are tensions there as well, you know, so actually what might work for your UK structure and might be best for that might not necessarily be as good for some of the other, you know, tax issues or some of the other investors. So again, it's managing those tensions.
And you might not get the right outcome for the manager and their carry and their income as well. So there's lots of balances to be had.
And I suppose one final point on that is it just means things might take a little bit longer to reach those decisions. So just building in a bit of that extra time frame to make sure that you have time to think about it.
Are there any questions on the floor?
What will Brexit mean for UK AFMs? Has someone got the answer to that? I think the FCA, just on that actually, Brexit, and I mean the FCA has sort of been coming out with some platitudes, hasn't it, about it's going to adopt an equivalent approach. So whatever happens on the 31st of October and so on, that there will be a UK AFM world, albeit maybe equivalents and so on. So it's I don't think people are. It's certainly something that will be bottomed out, but it's not a. And people would like to know the answer, but I think in the long list of things that Brexit needs to flush out, especially in the financial services, probably AFMD is probably a bit lower down the order. Patrick,
from a UK perspective, I think we're certainly seeing the one key thing for UK AFMs is post-Brexit, if it happens, that they won't be able to rely on the EU marketing passport under AFMD to market their funds.
You need equivalence and PPR, and that's going to, and we're fairly certain that that's going to. That's got to play out because you've adopted the AFMD rules, so the directive. So
we're looking at UK managers considering either relocating and setting up a manco in Luxembourg or looking to appoint third-party AFMs post-Brexit. And certainly we've had a lot of work in terms of re-domiciling UK funds and looking at how you can move them to Luxembourg to be able to take advantage of the passport in the future. So that's been the key driver.
What are the solutions for the fund to cope with the increased tax liability? Because I guess the point there is probably, you know, that the first point is that increased tax liability will be there. And I think the way to approach that is, you know, when you're doing modelling, is to do sensitivity modelling around it. So one of the things that people are facing at the moment is if they're sort of doing a transaction and saying, well, okay, I want to model, and I want to model prudently, i.e., you know, I want to model perhaps that there might be some withholding tax, for example. But then the question comes, well, hold on, if I do that, how do I compare with everybody else who's also trying to buy that asset? Am I going to be over prudent in that? So I think sensitivity is there as the key, and modelling different scenarios, because the reality is, in terms of solutions, you know, we are where we are. These are the rules that the tax liability is likely to increase. Looking at alternative structures, obviously REITs, alternative things which gives investors access to their own exemptions, their options clearly. But I think that probably the most important thing there is being realistic and modelling the tax that's likely to come.
Anything else on Slido? No?
Okay. If there's nothing else,
Patrick,
just finish off by saying a thank you to our speakers, Leonie and James. Round of applause.
Thank you.